This is episode 2 of the Average Investors Podcast. Hello, and thank you for joining me again. So, if you guys haven't listened to episode 1, I highly recommend it as this will be a continuation upon that. I want to start today's discussion with how a stock price is determined. So, let's start from the very beginning. Now, we have a private company that wants to go public. So, to do that, the company would have to work with another company called the underwriter. And a underwriter can usually be a bank or any accredited financial institution. So the job of the underwriter will be to determine the final worth of the company by looking at all facets of the business. Once they've determined that final figure, they will work with the company to determine the amount of shares that they want. And based off of those shares and the total worth of the company, they're able to get the share price. So to determine that, they will take the entire worth and divide it by the amount of shares that they want to release to the public. Now, how that works is, let's say you have a pizza, and that pizza you determine to be $15, and you have about 15 slices. That means that each slice of that pizza will be $1 each. Now that we've talked about how an initial stock price is determined, let's talk about how a stock price can go up and down. It's quite simple. It's all about supply and demand. Now take, for example, the home that you own. Let's say you want to sell it. Well, when you put it on the market, let's say that nobody's buying your house. That would start to drive the price down because you know it's not going to sell and it isn't selling. So you start to lower the price. Now it's the same thing if you start getting a lot of people bidding for your house because a lot of people want it. Well, then you get into a bit of a bidding war and the price starts going up. It's the same thing with stocks. So just like how a real estate agent would determine your house's price, the stock price is determined by the underwriter at the initial offering. And then when the stock goes on sale on the market, it's really determined by the supply and demand. So just like how people would come to buy your house, they would give you quotes for your house on what they're willing to pay. It's the exact same thing with stocks. Now, to give you guys an understanding of how to look at a company's net worth, of what it's trading for on the market, the share price, and how many shares are available for purchase in the total market. Well, you gotta download an app. Something that I recommend would be Yahoo Finance. It's completely free and you guys can use it, and trust me, you'll thank me for it later. So the way to look at it would be to first look at the market cap, which is the total worth of the company on the market. The second thing would be the share price. And the third thing would be the shares outstanding. Now, the share price is the price per individual share. The shares outstanding are the total amount of shares allotted to the public for purchase and ownership. And the market cap is the total worth of the company at that given time. Now, a way to simply do this yourself and to see how all the figures kind of add up would be you can either take the shares outstanding and multiply that by the current share price, and that's how you'll get the market cap. Or you can take the share price and divide the market cap by the share price to get the shares outstanding. Or you can get the market cap and divide it by the shares outstanding to get the stock price. So now that we've talked about how a share price is determined, how a share price can go up and down, what market cap is, what shares outstanding are, and what makes up that share price in all those figures, we're going to talk about something a little different. So I want to let you guys know on how you can technically make money off of the stock market. Now, the first way is called dividend stocks. So I mentioned this in the previous episode. So dividend stocks tend to interest a lot of beginning investors. But I want to tell you guys a little bit about the advantages and the disadvantages to dividend stocks. To give you guys a little bit of an understanding of exactly what dividend stocks are, well, dividend stocks are basically where companies will pay their shareholders a certain amount of money, either on a monthly, a quarterly, or yearly basis. Let's say you own a condominium and you're putting that condominium up for rent and you're collecting rental income for it. Well, you're going to use that rental income to help pay the property taxes, the mortgage, the insurance, and any other things that the tenant might not be liable for. In the end, you will be left with some income. So that's exactly how dividends works. The company will be using some of the income that they generate to pay for any expenses, for any growth, any acquisitions, and then they will pay out some of that profit out to the shareholders, also known as the owners. A real-life example of this would be TD Bank and RBC here in Canada, and in America you have Bank of America and Wells Fargo, which take some of the profits that they generate through the business and they reinvest some of those. They will use some of those to pay off any debts or liabilities that they may have and keep some cash on hand. But they also take a portion of those profits and pay them out to the shareholders, also known as the owners. Now that I've explained exactly what dividend companies are, you're probably wondering, what are the benefits? The benefits are quite easy, actually. You get to generate a continuous and very fixed income from those companies. So this means that you have a reliable income, much like a salary or rent would be. This is great for those that are looking to retire, as they can rely upon it during their retirement years. It's also great for those that may have a lot of money to invest and would like to create a second income for themselves. The other big benefit is, usually a lot of these dividend companies will grow the dividend over time. So just like TD Bank and other banks, they tend to grow their dividend year by year. Dividend stocks are also a great way of generating profits for yourself while you're in a bear market. So a bear market, just for your reference, is a market that is going down. And the final big benefit of dividend stocks is that if you don't plan on using the income that you generate from them for your own personal use, you can actually take that money and apply it back to those great dividend paying companies to allow it to really compound and accumulate at a much faster rate. Well, just like a coin, there's always two sides to this. So now that we've talked about the advantages, let's talk about the disadvantages to dividend stocks. You may be wondering, what could be the disadvantages to a dividend stock? I mean, making regular income from your investments just sounds amazing, something that you can rely upon. But let me dig a little deeper into that. You gotta understand that these dividends that you're making, they're being paid out from the company, the very business that you invested in. Now, what that means is, let's say if you owned a burger shack, and every time you had some profit, you used it to pay off any liabilities, and the rest you just used to pay yourself. Now, that's very similar to dividend stocks, in the sense that you're not really thinking about growing the business further at a faster rate. Because on the other hand, you could just use those profits and accumulate them to perhaps invest in another location or a bigger location, or perhaps to serve different things other than just burgers. Now, sometimes earning dividends is great, but if you can use that money, if the business can use the money to grow the business at a faster rate, wouldn't that be a lot better? Now, an example of a company that does this is Google. So Google has grown exponentially larger, and the share price has reflected that. Now, Google does not pay a dividend. What they do is they in fact take all those profits and reinvest into the company to grow their technology stack and to grow their service stack. Now you can take a company like Enbridge and put it up against a company like Google, and you'll understand that if you had bought into both of those 5 years ago for the same amount of money, your Google shares would far outgrow what you have made from dividends and reinvesting those dividends and the share increase in Enbridge versus Google. So one thing to note is that not all dividend paying companies pay out the same amount. So take for example Enbridge. Now Enbridge currently pays out 7% per year. What that equates to is 83.5 cents per share every quarter, 4 times a year. Now a share of Enbridge costs about $44 Canadian right now on the TSX. And if you take that 44 and divide it by what you would be making in a year, if the dividend were never to increase again, which it usually will increase every year, you will be able to make your money back in 13 years. Meaning everything on top of that would be gravy. But there is a big drawback to this. As a company with a high paying dividend usually has a little bit something to hide. So take for example Apple. Apple also pays a dividend, but they pay less than 1%. So Apple trades at about $120 US a share right now, and they pay out about 20 cents roughly a share per quarter, 4 times a year. Now that's not much. But what Apple can do is continuously grow that company just as they have been over many, many years now. And they are also growing the dividend at a very sustainable amount. Now what Enbridge is doing is actually paying out more in dividend just to keep the shareholders happy than they actually make in profits. They tend to pay out over 100% in 2020. Now what that means is they're paying out more and taking out loans just to pay out more to keep the shareholders happy. And they've also been increasing the dividend even though it doesn't seem sustainable. In the long run, this will really harm the business as there's no room to grow, and as their debts grow, those interest payments grow. The business could eventually be defunct. Now, I'm not saying that Enbridge will go defunct, but at the rate that they're going at, it's a highly likely scenario. To close off the dividend topic, I want to let you guys know a little bit about the key figures you should look at when you're looking into dividend paying companies. So that is first the yield, which is the percentage of dividend that they're paying out compared to the stock. So how that works is, let's say if a company is paying out 10% and the stock is $100, that means that they're paying out $10 in that year. So that's one key figure. The second one is the payout ratio. So the payout ratio is the amount of money that they're paying out compared to profits. So this is usually a percentage such as 10%, 20, 30, 40, or so on. The next key figure is the dividend growth rate. So this will tell you how much the company is able to grow the dividend compared to the last year. And you can even look at historical data to see how the dividend has grown over many years. Now this is a good indicator of showing the health of the company, because if the payout ratio is low, if the dividend growth has been doing really well, then this is a very sustainable dividend company. Now the next key figures to see are the ex-dividend date, the record date, and the payment date. So these three attribute towards the payment of the dividend. So the X date is pretty much the last date that you have to be able to purchase the share on to be able to be eligible for the next dividend payment. And then the record date is where they record the shareholders at that given time. And then the payment date is the day that you will receive the dividend. Now you can see all of these figures and key details on any company that's publicly listed on either Yahoo Finance, which is a completely free app, or even on Google, or pretty much any stock screening app. Well, now that I've talked about the advantages and disadvantages of dividend companies, I just want to give a little disclaimer out there. I do hold dividend stocks in my portfolio, but it's a very small part of my portfolio when you look at the grand scheme of things. And a lot of the dividend paying companies I have pay out a very little amount, as it's not the primary focus of my investing. My investing is for growth and long-term success. And to tell you guys a little bit about that, I want to share the second side of making money from stocks, which are companies that do not pay a dividend. So you're probably wondering, how would I make money from a stock that doesn't pay dividend? Well, it's quite simple. Those dividends that you're making are paid out from the profits that the company has made. But let's say if the company keeps those profits and keeps reinvesting in the business. Now, as I mentioned in the first topic, on how companies will grow and the share price will reflect that growth. So similarly, a company that uses the profits to help grow the business organically or by acquisition can also grow the share price. Now, to give you a real life example of a company that does this is Berkshire Hathaway. Now, Berkshire Hathaway is run by the legendary investor Warren Buffett. Now, if you haven't heard of Warren Buffett, do a quick Google search of him. You'll get a good idea. Now, Warren Buffett's Berkshire, since 1980 with a stock price of $425, has reached an absolutely astronomical amount that is trading today at $397,000 a share US. And how Warren Buffett and Berkshire Hathaway were able to do that is quite simple. They used the money from their profits to help buy businesses at really good prices, something that a normal person wouldn't have the capital or the reach to be able to do. That's how Berkshire has grown into a massive behemoth and acquired companies that you know, such as Duracell, Dairy Queen, Benjamin Moore, Geico, and also owns smaller parts of companies such as Apple, which is roughly 5% of Apple, and many, many other companies. If you look into Berkshire's history, you will understand a great deal of the advantages of not paying out your profits and instead using them to help grow the business. Now that I've told you guys how a company such as Berkshire can grow without paying out dividends and how the share price has skyrocketed due to them using that money in a smart way, let me tell you guys a little bit about the advantages and disadvantages to companies that do not pay a dividend. So the biggest advantage is what I've mentioned before, and the biggest argument against dividend stocks, which is that the company is not paying out profits. So in turn, they can use that money to continue to grow the business and focus on growth rather than satisfying the shareholders. Now, the second advantage would be, just as how I mentioned that dividend companies tend to perform really well and are good to have in your portfolio during bear markets, as they provide you a continuous income, well, the opposite is true for companies that don't pay dividends. They perform really well in bull markets because the company's growth really shows and can shine during uptrends in the market when the market goes up. Now, just for your reference, a bear market is where the overall market, the overall stock market, is going down, and a bull market is when the overall stock market is going up. The third benefit to companies that do not pay dividends is that they are highly focused on growth. They may be in a phase where they're trying to grow some service, or perhaps they have an amazing idea that they believe will generate a lot of money. Or perhaps they're about to acquire a company that they believe holds a lot of potential. So the benefit of them having that capital may be better used in their hands because they show promise in doing something spectacular with that capital. So now that we've talked about the advantages, let's talk a little bit about the disadvantages to stocks that do not pay dividends. The biggest disadvantage when compared to dividend stocks is the sheer fact that you will not have a reliable source of income coming from these stocks. So because stocks that do not pay dividends can fluctuate in price, one day they may be worth more, but the next day they may be worth less. So in the future, if you ever plan on selling these shares, you might be at a point where it's in a downtrend or a little beaten down. So that's the first big disadvantage. The second big disadvantage to stocks that don't pay dividends is sometimes just to see the end result, just to see the growth, may take a lot of time. So that's where patience comes in handy. But with dividend stocks, at least you're paid within the year. The third disadvantage is that these stocks do not offer any guaranteed profits like dividends. In fact, even breaking even may not happen with these. These types of stocks tend to be a lot more riskier, and that's why they require a lot more research and a lot more due diligence when picking. Now, with that said, I do advise that doing individual stocks, whether they do or don't pay dividends, I recommend to be very cautious. And if you are new to this, I recommend on holding off till we get a little further into it, and I can let you guys understand what a good pick and what a bad pick is, and certain criteria that you can look at to understand businesses. Now that we've covered dividend paying companies and non-dividend paying companies, I want to let you guys know that we've only scratched the surface. Stay tuned for future episodes where we dig a little deeper into these types of companies, and I can give you better examples and just give you a better understanding overall of what to look for. Now that about wraps up today's episode, and I want to let you guys know that if you haven't started investing, I suggest on holding off. And I also suggest on if you haven't made any big moves because you're just not able to understand exactly what's happening with your portfolio, please hold off for future episodes. Because right now we've only scratched the surface. There's a lot further that we have to go, and there's a lot more to learn to understand what type of investor you want to be, what type of stocks you want to hold in your portfolio, what type of risk tolerance you may have. Now understand that your portfolio will not look like mine. Mine will not look like yours. And it's just the way it is because no two people are the same. And their portfolios will reflect what type of interest they may have based off of profession or just personal hobbies, and what type of risk that they're willing to take with companies in regards to amount of money that they're investing to those businesses. Now, as I wrap up with my last remarks, I do want to let you guys know that there is a average investor's email that if you have any questions on anything that we've talked about or any future topics you would like me to cover, please drop an email at theaverageinvestors@outlook.com email. I'll be happy to answer you whether it's by email or if I bring up the topic on the show. Now, thank you guys so much for all the support that you guys have given for episode 1. I really, really appreciate it. Thank you and take care.